out of all of the tech stocks out there, which are the top 10 stocks that we actually want to buy right now, and which are the 10 stocks that we want to sell and run away from as quickly as possible? If you want to know that, stick around, because Winston and I have identified and combed through 100 tech stocks here. And trust me, the 10 stocks we picked as buys and the 10 stocks we picked as sells are going to surprise you. Now, we're not just going to hand you a list and call it a day. No, we're going to dive deep into the nitty-gritty of what makes these stocks tick. We're talking about 3 game-changing concepts that'll transform you from a casual investor into a market maestro. Now, I know what you're thinking. Felix, this sounds too good to be true. Well, my friend, that's exactly what I thought when Winston came up with the idea and started on the research by digging up something on the beach. But before we dive into the juicy details and the free bonus I'm going to hand you as well, let me let you in on a little secret. We've put together a comprehensive benchmark of these 100 tech stocks, the largest 100 tech stocks out there, and it's yours for the taking. Just head over to felixfriends.org/QQQ and download it. It's completely free of charge. Trust me, you're going to want to have this data in your arsenal as we navigate through today's stock market jungle. All right, buckle up, because we're about to embark on a wild ride through the world of stocks. We'll uncover the hidden gems, expose the ticking time bombs, and arm you with the knowledge to make informed decisions that could potentially pad your portfolio. By the end of this video, you'll have the inside scoop on 3 crucial concepts that separate the winners from the losers in the stock market, the top 10 stocks that are primed for explosive growth, and 10 risky stocks that could leave your portfolio in shambles. And that's just the tip of the iceberg. So grab your favorite beverage, get comfortable, and let's dive into the fascinating world of stocks. It's time to dive into the secret sauce of stock analysis. We're about to uncover 3 powerful concepts that will transform the way you look at potential investments. They aren't just any old metrics, they're the keys to unlocking serious wealth as an investor. Let's kick things off with gross profit margin. Now, I know what you're thinking. Felix, that sounds about as exciting as watching paint dry. But trust me, this little number is like a superpower for companies. Imagine a castle surrounded by a deep white moat. That moat protects the castle from invaders. Well, gross profit margin is like a financial moat that protects a company from competitors. The wider the moat, the harder it is for rivals to storm the castle and steal market share. Here's how it works. Gross profit margin is calculated by taking a company's revenue, subtracting the cost of goods sold, and dividing it by revenue. It tells us how much profit a company keeps from each dollar of sales before accounting for our costs. Let's break it down with a real-world example. Imagine 2 lemonade stands. Stand A sells a glass for $1. It costs them 50 cents to make. Their gross profit margin is 50%. Stand B, however, has a secret recipe that people love. They can sell a glass for $2, and it still only costs them 50 cents to make. Their gross profit margin, a whopping 75%. That extra 25% is Stand B's moat. They can use it to improve their product, lower prices if needed, or simply pocket more profit. It gives them flexibility and staying power that Stand A just doesn't have. They could also just buy Stand A and shut it down. That's what Google tends to do. Now let's move on to our second powerhouse concept, return on capital employed, or ROCE. If gross margin is the moat, think of ROCE as how efficiently the castle is run. ROCE tells us how good a company is at turning its resources into profit. It's calculated by dividing a company's earnings for interest and tax by its capital employed. In simpler terms, it shows you how much bang a company gets for its buck. In simpler terms, it shows you how much bang a company gets for its buck. Imagine 2 kingdoms. Both make 100 gold coins a year. Sounds about the same, right? But Kingdom A needs 1,000 gold coins invested to make that profit, while Kingdom B only needs 500 gold coins. Kingdom B is clearly more efficient, and that's what a higher ROCE tells us. Now, last but not least, we have our third concept, and then we're going to get into the actual stocks. Consistent increase in earnings per share. This is where the rubber meets the road for us as investors. EPS is like your slice of the profit pie. It's calculated by dividing a company's profit by the number of outstanding shares. A consistently increasing EPS means your slice is getting bigger over time. Who doesn't want a bigger slice of pie, right? But there is a twist to that plot. A rising EPS isn't always what it seems. Sometimes companies boost their EPS by buying back shares, reducing the number of slices rather than actually growing the pie. And that's why it's crucial to look at EPS alongside our other two metrics. Now, you might be wondering, Felix, how do these three concepts work together? Great question. Think of them as a three-legged stool supporting a strong investment case. A high gross profit margin, as a big moat, gives a company the resources to reinvest in growth. Effective use of capital, high ROCE, turns those resources into profits efficiently, and a consistent earnings per share growth shows that the company is translating those profits into value for shareholders like us. Remember, no single metric tells the whole story. It's the combination of these three: high gross profit margin, strong ROCE, and consistently increasing EPS that often points to a company with a sustainable competitive edge and effective management. So next time you're eyeing a potential investment, don't just look at the stock price. Dive into these three metrics and you'll have a much clearer picture of the company's true value and potential. And if you've downloaded that spreadsheet I've given you, then you've already got the data. Links down below. Now that we've armed you with these tools, are you ready to see how they play out in real-world examples? Because we're about to reveal some stocks that are absolutely crushing it in these areas. All right, buckle up. We're about to dive into the creme de la creme of the stock market. These aren't just any old stocks. These are the thoroughbreds of Wall Street, the companies that are leaving their competitors in the dust. And trust me, these numbers underneath them are going to blow your mind. Let's kick things off with Autodesk, the software giant that's been quietly revolutionizing the design and engineering world. Now get this, Autodesk is sporting a gross profit margin of 91.7%. That's not a typo. For every dollar of revenue, they're keeping 91.7 cents as gross profit. Talk about a moat. But it gets better. The return on invested capital is sitting very pretty at 24%. That means they're not just making money hand over fist, they're doing it efficiently. And with an EPS trend score of 0.75, it means that they're consistently delivering value to shareholders. Their earnings per share are going up 75% of all quarters. So it's going up very, very consistently. Now let's shift gears to Cadence Design Systems. Similar to Autodesk, Cadence is rocking a gross profit margin of 88%. That's like selling water in the desert. People are willing to pay a premium for their product, but it gets even shinier. Their ROIC is a staggering 22%. It's like turning water into wine. And they're not just making money, they're making money work for them. And with an EPS trend score of 1, they're hitting it out of the park with a perfect score on earnings per share growth. Moving on to Adobe, the company that's probably responsible for half the PDFs on your computer, maybe all of them. They have a gross profit margin of 88% and a really impressive ROIC of 30%. That's higher than both Autodesk and Cadence. Adobe isn't just a one-trick pony. They're efficiently generating returns across their entire business. Talk about our next favorite here, VeriSign. You might not know the name. Well, you've probably seen it on a website somewhere, but you've definitely used their service. They're the folks who make sure you can trust the .com and .net websites that you visit. And it's a very lucrative business. They boost a mind-boggling gross profit margin of 87%. Their operating income margin is 67%, the highest among all the stocks that we've looked at. And the next one, it's a stock you probably know better than any of the other ones. It is Booking Holdings. Booking.com, indeed. Priceline. Kayak. Now, travel might seem like a tough business, but Booking has cracked the code. They're sporting a gross profit margin of 84%. And their net income, to common margin is 22%, which is insane. So they're not just making sales, they're making significant chunk of that revenue all the way down to the bottom line. Let's shift our focus to another industry. We're going to jump through industries here. AstraZeneca, the pharmaceutical powerhouse, has been making waves in healthcare. Now get this. AstraZeneca is sporting a gross profit margin of 82%. It's like turning water into gold. It's almost as if they have, an insight into regulators and sort of have an unfair advantage or some sort of undue influence getting vaccines out. But anyway, where it gets really interesting is the return on invested capital, 14%. Doesn't sound as impressive as some of the tech companies we just looked at. But for a pharmaceutical company, that's like hitting a home run every single time. And the EPS trend is 1, which means they're consistently delivering value to shareholders. It's kind of like the trifecta that we're looking for. Now, next on our list is Airbnb. Again, kind of travel, the company that's revolutionizing the way we travel. And you might think the travel industry is, again, a tough nut, but Airbnb makes it look easy. Gross profit margins are 82%, same as our pharma lovers, AstraZeneca. So it's a moat that's so wide you could sort of cruise ship through it. And their net income margin is, again, 46%. So for every dollar of revenue, 46 cents is pure, unadulterated profit. Next, we move to a little bit of a bigger beast, Meta, formerly known as Facebook. Love it or hate it, you can't deny their financial prowess. Meta is rocking a gross profit margin of 81%, but what's really mind-blowing is their ROIC of 27%. They're not just making money, they're making money work for them like it's going out of style. Next, we have Synopsys. You might not have heard of them, but they're one of the unsung heroes of the semiconductor industry. The gross margin is stellar 80%. ROIC, 17%. Earnings per share trend score, 0.87. Remember, 1 is a perfect score. It's pretty impressive. And last, but certainly not least, we have Intuit, the company behind TurboTax and QuickBooks. Their gross profit margin is almost 80%. But the real beauty with this business is that their ROIC is 30%. That's higher than any other company that we discussed today. They're not just helping others manage their money, they're masters at managing their own. Now, you might be wondering, what's the common thread here? How do I identify these myself? All of these companies have found a way to create significant value for their customers. It allows them to charge a premium and maintain those wide moats we talked about. But there's a little bit more to it. They're also incredibly efficient at turning their profits into more growth. They're reinvesting in their businesses, therefore staying ahead of the competition and just consistently delivering value to us shareholders. Now, before we wrap up, it's important to remember that investing isn't just about finding winners. It's also about managing risk. In our next segment, we'll take a look at some of the stocks that might be facing challenges. This information could be crucial for balancing your portfolio and making informed decisions and maybe avoiding a few potholes, so stick around. So let's shift gears and take a look at some stocks that might be facing headwinds here. And remember, understanding risk is just as important as finding the opportunities. First up, we have Ross Stores. It's a popular off-price retailer. At a first glance, their numbers might not seem too alarming, but let's dig a little deeper. Ross Stores has a gross profit margin of 32%, significantly lower than the high flyers. Their narrow margin leaves them with less room to maneuver in a competitive retail space. Their return on invested capital sits at 18%, which isn't bad, but here's where it gets concerning. Their earnings per share trend is, 0.75%, still growing, but not as consistent as some of the other ones. Could be the beginning of a red flag, especially with the low margins. Then we have Dollar Tree. Now, you might think a discount store could be recession-proof, but the numbers tell a different story. Dollar Tree's gross profit margin is slim, 30%. In a business where every penny counts, this doesn't leave much room for error. Their ROIC is even more concerning at 7.5%. That suggests they're not getting great returns on their investment, which could limit their ability to grow and adapt. And then their earnings per share trend score of 0.37 means that their earnings growth is far from consistent. It's like they're walking without a safety net. There's another household name here that just made the headlines last week, Starbucks. Now, I know what you're thinking, Felix, how could my favorite coffee shop be on this list? Well, look at the numbers. The gross profit margin is 27%. This might be okay for a food business, but it's a far cry from the tech giants we looked at earlier. And I haven't actually got the data for the ROIC, which is a little perplexing. But the earnings per share trend score of 0.5 suggests it's a coin toss whether or not profits go up per quarter. So in a world where trendy new coffee shops are popping up on every corner, where McDonald's serves cheap coffee and so on, these numbers might make investors a bit jittery. Now let's talk about another stock here, Constellation Energy, an energy company. They're operating in a different world from tech and retail, right? Their gross profit margin sits at 19%, which might be concerningly low, though not that unusual for that industry. In the capital-intensive energy sector, this doesn't leave much room, though, for investments or for weathering market fluctuations. An ROIC of 9.6 isn't terrible, but again, it's not exactly electrifying either. However, they do have a fairly solid earnings per share trend score of 0.8, so their earnings at least are going up. But an industry facing pressures to transition into whatever the brave new world might look like, that could be a challenge. And then lastly, we have PACCAR, P-A-C-C-A-R, a leading manufacturer of trucks and diesel engines. The gross profit margin there is 19%. It's the lowest we've seen so far on our list. In an industry known for tight margins that could leave them vulnerable to economic downturns or supply chain disruptions. And their ROIC stands at 15%, which is actually quite respectable. And they do boast a perfect EPS score of 1. So why are they on our watch list? In an auto industry racing towards electric and autonomous vehicles, PACCAR's heavy reliance on traditional diesel technology could pose a significant risk to their future growth. But let's continue to explore potentially risky stocks here. Walgreens Boots Alliance in full. One of the largest pharma chains, you might expect them to have a healthy financial profile, but their gross profit margin is just 18%. In a competitive world of retail pharma, that slim margin doesn't leave much room for error, and their return on invested capital is a very concerning 2.5%, suggesting they're struggling to generate returns from their investments. The earnings per share trend score is just 0.25. That means their earnings are falling 75% of the time, far from consistent. So in a healthcare landscape that's rapidly changing with online pharmacies and telehealth services and so on, these numbers could spell trouble. Then we have Micron Technology, a major player in semiconductors. But their gross profit margin of 11% is alarmingly low for a tech company. Compare that to Nvidia's, 70% plus. In an industry known for its cyclical nature, this thin margin could leave Micron vulnerable during downturns. And their ROIC stands at minus 2.6%, which means that they're actually losing money on their investments. Perhaps it is the nature of the long investment cycle that semiconductors are known for. That's the problem here. But their earnings per share trend score at 0.25 is about as horrific as that of Walgreens. So it doesn't leave us with much confidence. Now let's take a look at Moderna, a company that became a household name during the COVID-19 pandemic for allegedly producing a vaccine that isn't actually a vaccine, but it's a whole different story. Their financials tell a rather complex story. Their gross profit margin is negative, so they're losing money on everything they're selling. Not uncommon for biotech companies investing heavily in R&D, but it's still kind of a red flag. Moderna's ROIC is minus 25%, reflecting the heavy investment phase that they're in right now. And the earnings per share trend score, well, I haven't actually got one because it's too choppy. So while Moderna has potential to benefit from the next pandemic, these numbers highlight that biotech and pharma companies are very risky and very cyclical. And lastly, we have Lucid, an EV manufacturer. Now, Lucid's gross profit margin is minus 162%. That means they're spending far more to produce their cars than they're selling them for. Could be a scale issue. They need to just make a lot more to actually get there. That's the challenge of a startup. But with a return on invested capital of minus 34%, it indicates they're burning through investment capital at an alarming rate. Now, as we wrap up our deep dive into these stocks, it's crucial to remember that investing is about more than just the numbers. Each of these companies has its own stories, its own potential for turnaround or growth, but the metrics we're looking at here are very powerful. They're not crystal balls, but they are very powerful. So we've covered a lot of ground here today, from the soaring heights of our top performers to the potential pitfalls of our riskier EV picks. Let's recap the key takeaways here and discuss how you can apply these to your own investment strategy. Gross profit margin is like a moat. It's really, really important. Return on invested capital shows you how efficiently a company is managing their investments. And then a consistent earnings per share growth is the cherry on top. We've seen how companies like Adobe, Autodesk, Meta have used these principles to build formidable business, but we've also seen how well-known names like Starbucks and Walgreens can face challenges when these metrics start to slip. The lesson here: never stop digging. That's also Winston's mantra. The stock market is a little complex at first, but if you can narrow it down to a few key numbers like this, it actually becomes much, much, much easier. So how do you apply this? Well, remember that full 100 stock benchmark I mentioned earlier? It's time to put it to work for you. So head over to felixprehn.org/QQQ, download the complete benchmark. It's free of charge. And this is a powerful tool that breaks down these crucial metrics for the 100 stocks that are part of the NASDAQ. So it's like having a financial analyst in your pocket helping you spot potential winners and avoid costly mistakes. Now, of course, always still do your own bloody research, but it's a great starting point, I hope, for you. And if you got some value out of this video, smash the you-know-what, share it with somebody. And of course, we should thank my trusty golden retriever, Winston, for his unwavering digging. Remember, the path to financial freedom is paved with learning the skill of managing money. So go ahead, download that benchmark and take the first step towards becoming more informed and confident as an investor. Until next time, all the best. Imagine a world where artificial intelligence runs everything, from your coffee